right, so we're encroaching the end of 2020. Thank God that we're getting to the end of this. But if you have any type of stocks, cryptocurrency, maybe you're looking to sell a house, or even sell some gold if you have some, what does that mean? Well, you come to the right place. Thank you for tuning in to another episode of Frank Finance, where you can get your honest financial information and your questions answered. All right, so just like done before, we're going to go to an Excel spreadsheet and I'm going to walk through each one of the asset classes. But before we do, please remember, like, subscribe, and comment below if there's any information you would like to hear. All right, so what you see in front of you here is the three different asset classes. You've got the stock and crypto, you've got gold and personal home. When you think about all the asset classes that you have, one of the first things you need to think about is how long have you actually held the asset. The reason why this is important is because when you're thinking about investments in these three different asset classes, there are favorable tax benefits if you hold them for longer than a year and longer than 2 years if it's a home. All right, so what's the difference between ordinary and capital gains? Well, ordinary represents the rate in which you pay on your federal taxes today for your taxable income, and capital gains represents the favorable rates in which you pay only 0, 15, or 20%. So starting with ordinary quick, so we get grounded on this. On the right, I have the percentile buckets that represent a certain threshold of taxable income. So for instance, anything that breaks this, call it first bracket, if you have taxable income of more than $10,000, you would pay 12%. If you have more than $50,000, you'd pay 22%. Mind you, these are tiered systems, so the first 10,000 is at 10%, the next 30,000 is at 12%, and so forth. Okay, but for purposes of this, when you sell a stock and you're already in one of these brackets, every dollar you make is on that bracket. So for the instance of thinking about when you sell your investments, it's not a tiered system anymore. It's whatever bracket you're in. So keep that in mind when we're talking through this. And then secondly, capital gains, I had mentioned 0, 15, and 20%. Well, how do you fall into that? Well, those that make less than $40,000 in taxable income pay 0% on capital gains. Those that are between 40 and 440 are subject to the 15%. And those that make more than 440 obviously are subject to the 20%. Two things to keep in mind when you're talking through this, whether it's ordinary or capital gains, is first, FICA taxes, Social Security, and Medicare, which are about 7.5%, is not subject to investment income. Also, the other thing to think about is there is a 3.8% Medicare tax that is out there for those investment income above certain thresholds that are a part of the Affordable Care Act that help fund that. I am excluding that from this analysis, and those that make the count of money for that probably aren't watching this video anyways. Let's talk about stock and crypto first. And obviously, if you have less than a year, you fall into ordinary income taxes, and if you are greater than a year, you will fall into the capital gains. For the illustration of this, we're going to use $50,000 as an individual's taxable income, which means that if you make around $60,000, $65,000, that's probably where you'll fall. You invest $5,000 in today's environment. You went into a stock that doubled in 2020, and you're like, should I sell it? What do I need to know? Well, first and foremost, if you have $5,000 stock, it grows to $10,000, and you have a $5,000 gain, you are subject to your ordinary income bracket. So as I mentioned, that would be 22%. You would then owe $1,100 in April when you file your return, which would mean your ending value on that stock would be worth $8,900. It's still a nice gain, but should you have waited a year? Well, here's what will happen if you wait a year. That $5,000 is still a market value of $10,000 in this bucket. But now if you have it greater than a year, you fall into the 15% capital gains rate, which means you actually only pay $750 in taxes, obviously due in 2022 in April, which would mean the ending cash value is $9,250. All right, so two things that I want to talk about when it comes to stocks, because they're unique to stocks, is that first and foremost, The stocks, if you were to have to sell them at a loss, you are allowed to carry forward losses indefinitely and offset them against future gains indefinitely until it is gone. Also, if there are no gains, you're able to subject $3,000 of ordinary income against those losses in future years. So keep that in mind. If you do have to sell at a loss, it's something to consider. And if you sell your stock in December as a loss and you turn around and buy it in January, less than 30 days, it's considered a wash sale, and it will change the results of what you can carry forward and how it's treated. I would highly recommend going and watching a video on wash sales. The other thing, dividends are giving you cash today in hand. You decide to reinvest it, it doesn't matter. It is a taxable event and it is treated as ordinary income there and then. Hey, I'm going to reinvest it. That just starts the ticker of another year until you can get the favorable tax benefit. So keep that in mind when you're reinvesting dividends. Everyone that's this hype train right now that's all about buying dividends, you are paying ordinary income on every piece of those gains that you get for dividends. You're not getting favorable capital gains off of that, so keep that in mind, whether you're considering growth stocks versus dividend stocks. All right, second asset class, which is considered more of a collectible type of asset class, gold, silver, those type of items. The only thing that's unique here is if you have more than tax bracket of the 28th percentile, will you gain benefits? And the reason for that is because collectibles are actually taxed at ordinary income, capped at 28%. So unless your taxable income is above $163,000, you're going to pay the same rate no matter what. So don't worry about a year versus less than a year on gold. So the final bucket, which is a personal home, thinking about this, you have to really think about the three categories, because what we've just learned is less than a year, greater than a year. But then there's a third unique situation for a home, which is if you have a home for greater than 2 years, anything up to $250,000 in gains are not taxable. Cost basis, you bought a house for $200,000. The house appreciates in value to $450,000, which gives you a gain of $250,000. That'll be consistent across all of these. I'm using the $250,000 in gains so you can really see the difference between the three buckets and how that rolls through. So if you're less than a year and you sell your asset, you're subject to ordinary income on everything, which means the $250,000 in gain gets added to your, call it $50,000 of taxable income, to land you at $300,000 for that year. What does that mean? $300,000 falls into the 35% tax bracket, which means you'll actually have to pay nearly $90,000 in taxes on that to get you to a net value of $362,000. What happens if it's greater than a year but you can't wait for the 2-year mark? Okay, you actually now fall into the capital gains rates of the 0, 15, and 20%. Mind you, a gain of $250,000 does not break the $440,000 I had mentioned earlier, which means you would be in the 15% capital gains rate. So now this same instance, you would only pay $38,000 in taxes rounded to get you to an ending value of $413,000. You can see how that's a very significant jump if you hold your house for greater than a year. All right, now the final bucket, if you have a house that appreciates to $450,000 and you sell it and you've been there for longer than 2 years, you will not have to pay any taxes on that gain. All right, so I hope this video today helped you think through whether or not you should sell an asset, and if you do, the timing means everything on whether or not you get favorable tax treatment. As always, you really need to think about this in your individual state and your own individual situation. There are plenty of different things outside of this illustrative purpose that I've gone through to where you really need to work with your tax advisor on this. And this by no means guarantees the rates that I had stated, but are a very good starting point for you to understand the differences. With that, I hope you have a great rest of your day. Bye now.